Let's get more reaction to the minutes from an economist who got it right with his call for 7 rate hikes last year. Actually, he was too dovish. Ethan Harris is back. He's head of global economics at Bank of America Global Research. And Ethan, people want to know about the minutes, so I won't dwell. But again, you were way ahead of the rest of the pack with your call last year. What do you think about what you're hearing from the Fed right now? Do they have it right?
I think they're doing the right thing, and I think Steve's absolutely right. I mean, they are trying desperately to convince the markets that they're serious here. It's amazing. The bond market doesn't believe them. Bond market's only pricing in a peak funds rate of 5%. It's got the Fed cutting steadily starting in the second half of this year. The equity market has looked pretty good, strong as well. Markets don't believe the Fed's serious about fighting inflation. I think they're wrong. I think the Fed will deliver more than the market's expecting.
Wow. So the market's expectations are already pretty high, Ethan, and we have a lot of the forward indicators sending us pretty worrisome signals. You know, the prices paid to the ISM is collapsing. The yield curve, pick your poison. They're all terrible. And yet you think they're going to do what? Then how far are they going to go?
Yeah, so what they've done is they've told us that they want a weak economy. I think that's a very friendly way of saying they want a recession. I mean, let's get serious here. You've had almost 10% inflation in the United States. You are seeing inflation drop due to a reversal of some of these goods price spikes, you know, as commodity prices come down, as we've seen in the ISM, as supply chains reengage. Those kind of short-run inflation pressures are disappearing. But one of the other things the Fed's been focusing on here, they're saying that's not what we're looking at. We're looking at the parts of inflation that are going to be hard to get rid of. How do we stop all this labor cost pressure that's driving service prices? That requires you have a much weaker economy. The economy's just not cooperating. Look at the JOLTS data this morning. I mean, the number of job openings is still through the roof. So they got a lot of work to do. And unfortunately, I do think they end up creating a recession. So the fact that there are signals suggesting a recession's coming isn't going to stop the Fed.
You see inflation in 2023 of 2.5% on the headline PCE. That's one of the measures. The other core coming down to 2.5%. That is not far above what is said to be the Fed's target of 2%. If inflation is going to go there, in your view, does that mean that the Fed is almost done raising interest rates? In other words, do they need to continue raising rates to get to that level? And if so, by how much? And when do they stop doing that?
Well, I think they've got to finish the job here. I mean, if you agree with Powell, who's saying that the major sticky part of the inflation process is rising labor costs, and then you look at a job market that is still red hot, there's no way you're going to get inflation down to 2.5% with this labor market. It's unfortunate the Fed let things overheat, and now they have to take back the punch bowl. But I think they still have to keep hiking. We're assuming another 75 basis points of rate hikes. And by the way, if the labor market continues to defy gravity here, I would think that we'll see a further hike beyond what we're forecasting. So there's a lot of work to do. They have to finish the job.
So another 0.75 of a point to a point of rate hikes, but you can do that pretty quickly. That could be 2 meetings. That could be the February meeting and the March meeting, and then you could be done.
You could be done. I think what you need to see, they need to see clear evidence that service inflation is cooling, the labor market is stopped growing, unemployment rate is rising, and most important, that job openings are coming down to earth again. They need something to grab onto that says to them that they're winning the war. Getting the used car prices to come down after having them go up 50% is not winning the inflation war. Winning the inflation war is getting the service side of the economy under control. You have to have both. You have to have lower goods price pressure and lower service price pressure. So they need to see convincing evidence in the labor market and in the service side of the economy.
Steve, is there a risk that they wait to see the whites of the eyes of that slowdown, which is responding while setting monetary policy with conditions that are going to hit 12 to 18 months from now? You know, I know we don't have great, coincident or even forward-looking data, but it feels a little scary that they want to wait for two of the most lagging data points in CPI and the labor market to respond with policy that's going to continue to set a course a year and a half from now.
It's not only the risk of it, Kelly, there's almost certainly the likelihood of it. And I think Ethan's sort of telling you that. I think the Fed is kind of telling you that, in that they are not that concerned about it. I read these minutes looking for some cadre, cabal, core of Fed officials who were more concerned about that than the rest of the group, and there really does not appear to be one. I think it's instructive what Neil Kashkari came out and said. I'm at 540 or bust right here. Mary Daly says she's over 5%, and we have that chart from the Summary of Economic Projections, which show that 17 of 19 officials are over 5. This is a risk they're willing to take. They feel like the risk of higher inflation is one that outweighs, I guess, by a long way, the risk of going too far and doing too much. I think, when I read these minutes looking for any sign of any sort of nascent dovish wing on the Fed, there's this paragraph in there, guys, and some of these issues are brought up, but they're very quickly and rather decisively dismissed.
Let's not forget that all the doves in the FOMC have been voting with the policy. Right. There hasn't been a single dissent. They've done.
No, Ethan, I was trying to figure it out. Ethan, I think there was one dissent, and I think that was Esther George, who's hardly a dove, and I'll be interviewing her tomorrow. But I think that's right, Ethan. I was trying to total up. I think this entire time of the historic 75 basis point rate hikes, there has been a single dissent. So there are no doves in the foxhole of inflation right here.
Yeah.
And I thought she dissented for a different reason too. It was like but was it financial conditions?
It was concern about what she wanted to do, and I'll ask her about this tomorrow, Kelly, is she wanted to protect the balance sheet runoff, which is something we're probably not talking a lot about because there's going to be more than $1 trillion of balance sheet runoff this year compared to $400 billion last year, and it's going to start to, I think, have a fairly profound effect in markets.
You're absolutely right.
Already.